What's up everyone, my name is Anthony and in this video I'm going to introduce to you the Iron Condor options trading strategy, which is something a little bit different because it incorporates multiple option types within one spread. So my goal of this video is to first break down to you the details of how the spread works and then show some specific examples of when you would use the strat and then walk through two different brokerages and how you can queue this up yourself on your own account. And then I'll go over some details of the spread of the Iron Condor strategy that you usually won't really find in a lot of textbooks and something that you just gain through experience of doing this strategy. So if you feel like this video is useful for you, feel free to hit that like button and subscribe to the channel. And be sure to join the Discord where the link is down in the description below if you haven't done so already. For subscribers to the Discord, I post all my trade signals and all recommendations for the markets as well as whatever I'm looking at the moment. And so yeah, be sure to join that if you haven't done so already. So we're going to get started, and first of all, I'm going to introduce to you what exactly this strategy is. So when I say it's a four-leg strategy over here, this just means that every Iron Condor spread is going to have four parts. So you're going to buy four options and sell, or you're going to buy or sell four options per spread. And the entire goal of the strategy is to simply make money off time. And as you know, time is theta decay. So when prices move sideways and don't really do anything for a long period of time. So for example, in the SPY right here, so this is the S&P 500. And as you can see, in this trading period, like right over here, prices are just bouncing back and forth within a range for a couple of days, a few days. And this is where you would make a lot of money off Iron Condors. Whereas other option strategies, such as simply buying calls or puts, would not get you any money. So even if you bought, let's say you bought calls down here, just a simple one option call, if you bought it down here, you would end up losing money at this point, even if the prices are a little bit higher, just because you lost money to theta decay and time. Well, now if you trade the Iron Condor strategy, you're the one making money off that time. So you actually want prices to stall out. This is why I really like the strategy, because it's very unique. It's one of the strategies that actually gives you money off prices doing this unfavorable price action. But yeah, so in my Discord, I actually did play a lot of, I played some Iron Condor strategies, and I had some people asking exactly how the strategy works, and so I'm happy to make that video for you and explain some of the details. So first of all, if we think that SPY will stay within, let's say, so I have an example here. If we think that SPY will stay within 421 to 426, this is where we'd use an Iron Condor strategy. So the way you set this up is by doing a series of four options. So you want to buy a call, buy a put, and then sell a put, and then sell a call. And the structure at which you do that, and I'll show you first through Robinhood. So in my opinion, I don't really use Robinhood as much for trading, so I have a kind of a demo account here, but I really think that for spreads and complex spreads like Iron Condors, this is where Robinhood shines because it helps you, it really makes it clear what you're doing. So I'm going to show you how to do that. So for this example, let's say, so we're going to do a 421 to 426 Iron Condor strategy, and I'll show you what that means. So if we go into the brokerage here, you want to first buy a SPY call 427, and keep in mind I'm using June 18th expirations. It doesn't really matter right now like what expiration we're using this. I just picked this arbitrarily, but the important thing to know is that all of the options you buy have to be the same expiration, or this is not an Iron Condor strategy. So we first bought right here the 427 call, and now we're going to sell the 426 against it. So a good thing to remember is that for Iron Condors, you're always going to sell the more expensive thing against what you buy. So we bought something that's worth $110 right here, and now we're selling something that's more expensive, so $153. And this is why you get money up front from doing an Iron Condor strategy. So that's just to remember. So that's your your call part of the Iron Condor. Now we're going to go to puts. So we want to go down to these areas right here, so a little bit lower. So let's first sell the 421 put, and we're also going to buy the 420. And just like previously I said, you're selling the more expensive option right here, and you're buying the lesser of the expensive options in terms of your puts right here. So now you notice that Robinhood is going to automatically recognize this as an Iron Condor. And when it says short Iron Condor, this just means that you're essentially selling a spread. You're never really going to go long in an Iron Condor. So if you ever go a long Iron Condor, that just means, so right here, this is our profit loss graph. When you go long for an Iron Condor, you're essentially flipping everything. So for here, you're getting profit when it's staying within a range. If you go a long Iron Condor, you're going to get profit off being outside of the range. So I don't think you would ever want to really do a long Iron Condor unless like some very specific circumstances. But Yeah, so you're pretty much always going to want to short iron condor. And this means you're getting credit immediately up front. So as you can see right here, with this spread, and I'll bring back the example right here, this is exactly what we're doing. So I'm going to put them side by side right here. So we have the short iron condor exactly, and this is what we just did. So now I'm going to break down to you where you would profit and where you would lose money. So over here, I said this is a 4-leg strategy, so we're going to break down these individual price points. So our lowest strike price of all the options is 420, and this is our put. So let's start off here. So let's say SPY so we took June 18th right here. So this is basically in around 4 days. So if SPY is under less than 420, so say it's like 418 for example, we will have full loss for this spread. And what that means is, so what we can see here, so the total credit we're receiving is $62. So as you remember from options, if you ever see this, like a 0.62, multiply it by 100 because you're dealing with 100 shares of SPY. So you're going to get $62 immediately. And let's say we do one iron condor. So now it's going to ask you for some collateral. And what this just means is that Robinhood is asking you to deposit money aside just in case the spread goes wrong and you end up losing all of your money. So the maximum you can lose from this strategy is $100, but you're also getting $62 from just opening the strat. So what your current profit or your maximum profit would be the $62, but your maximum loss would be 100 minus $62. So that would be $38. So I do have numbers here. These are not quite exactly, so we can actually adjust these. I'll do this with you. So our premium received right now is $62. And if we adjust that here, so 62, and now we're going to get $38 loss. So this is our maximum loss right here, $38. And this occurs if SPY closes under 420, because that means pretty much these calls and these puts are, the strikes are all above the current SPY price. So this is you don't want your SPY to be under any of these or above 427 or under 420. That's not what you want, because your iron condor strategy is trying to keep prices within a certain range. So there we go, and now we're going to go up here. So this is another scenario where we get a full loss on the trade. So we do $100 minus $62. It's the same thing. This is where every option pretty much expires when the SPY price is above your highest strike price, so 427, and you similarly get a $38 loss. So that's your maximum loss. As you can see here, this is a pretty favorable risk to reward. You can only lose $38, but you can gain $62, which is pretty good. And we're going to experience that if we close less than 420 or above 427 by June 18th, 1 p.m. our Pacific time. So basically when the markets close on Friday. And now we're going to analyze the break even. So this is a little bit more complicated. So our break evens are going to be determined by the amount of premium that we receive. So let's say we got $62 premium. I'm going to simplify it, or actually, let's just put 62. So basically, your break even on the this part. So basically, if SPY is closing between 420 and 421, within this range, you'll see some sort of break even. Basically, your spread will be worth the same amount that you paid for it. So I'm going to simplify it to say 420.4, and we're going to simplify it like this. So you don't have to worry too much about what happens here because it can be a little bit complicated. The spread, because there's 4 options, there's a lot of variability with the amount of money you get. But your break even will be somewhere within 420 and 421. And you can calculate it manually, and that'll be around 420.4. So let's say we have 420.4 right here. If we close above 420.4, but less than 421, we're going to get profit. But it's not going to be your full profit. It's going to be somewhere between. So you'll end up getting around like maybe $50 per spread, $30 per spread, but you'll get profit. And if you're between these ranges, you won't experience the full loss, but you will receive some sort of loss, maybe like a $20 loss per spread or a $10 loss per spread. But that's just the details. You don't really have to worry about that unless it does fall in between these ranges. So now this is where it's good. We get the full profit if SPY is between 421 and 426. So this is the ideal situation. And in the iron condor that I posted in the Discord before, the end price of SPY was right in between these two numbers, so we did get the full 100% profit. And that just means you keep the premium you receive. And then Robinhood, what they will do is they will pay you back the $100 collateral that you initially paid them. And so that will give you all the money back. That's simple. If it closes between the middle two numbers, so we have 420, 421, 426, and 427. So you notice the middle numbers are 421 and 426. So if we're in within these two middle numbers, that's full profit. And now we're going to go on to the next break even. So simply we just take the around the 0.6 premium, and this is where our second break-even price is. And I think on Robinhood it actually does show you, if I look here, so it does show you exactly this. So you can see Robinhood is already doing it for you, which is very nice. This is the one place where Robinhood is pretty good. So this is basically exactly what I'm saying. If you can see full profit between 421 and 426, and then right around these areas, so between 420 and 421, you'll have that break even. Same with the 427 and 426. So, and it also summarizes that for you here. So if you're using Robinhood, that's really good. Good news, it will definitely help you understand the strategy as well and your exact profit and loss calculations. And just be sure that you're doing exactly the same buy and sell options that I'm showing you here, because you want to make sure that it recognizes as an iron condor strategy. And additionally, if you do have trouble, if Robinhood is having trouble recognizing the strategy, you might also want to check that you have spreads enabled on Robinhood, because you do need to have that in order to do the spread. So now if we look at SPY, so let's go back here. So if we can kind of mark out those areas, so 426 right here, and then 421 down here. So let's say that SPY kind of bounces between this range. It goes up here, maybe it comes up a little bit and then comes back down. And then now when it's Friday, it's right within the middle. That's going to be your full profit zone. So if you do see SPY sort of coming up here and then kind of staying there, you're going to start losing money on the spread. So you have to be careful. The good thing about iron condors is that it's very easy to exit with minimal loss, because you won't start losing the full amount until you get really close to expiration. And I'm talking about like an hour or 2 hours before the actual expiration date. But so now I walked you through how to do this on Robinhood. Now I'm going to go to Tastyworks. So this is what you might expect to see on a lot of other brokerages. It's a very just an option table, and it's a lot different than Robinhood. It's a lot less beginner friendly, and I'll show you exactly how to work through this. So specifically on Tastyworks, they do have the strategy already mapped out for you. You can just click on Go, and it will kind of show you the legs and how you can just kind of manually assign them yourself. But for those options, maybe I think Webull does not have this really fully implemented. We can manually do it. So you don't really want to buy and sell everything individually. For example, you don't want to buy the 421 call and then sell a 421 call after that. You want to do everything at once. You want to submit everything in the same order, so that while you're submitting the orders, you're not really. So say you buy like just a 427 call, and you're taking the time to sell everything against it. While you're doing that, your 427 call could be losing money. So you don't really want to have that risk. So let's say you're going to do an iron condor strategy and you want SPY to stay within 421 to 426. So we're going to do that exactly. So let's first buy the 427 call. So to do that, you just click your regular buy order. It's just regular buy call. And now you're going to sell. So for me, for Tastyworks, all you have to do is just click on this, the left side of the option prices. So now you've bought a 427 and then you've sold a 426. And you already see you're getting credit for that. So now we're going to go back to the puts. So over here, here's the put side. So we're going to buy the 420 put right here. So we're going to buy that. And then we're going to sell a 421 put against it. And as you notice, the 421 put is worth more premium than the 420 put. And that's why you get credit. So we can see here we're getting 0.63 premium. And this is essentially what we're seeing on Robinhood as well. So just a little bit of difference, $1 difference. That's just natural for brokerages. But as you can see, it's basically the exact same thing. So as we can see here, if we look at the theta decay right here, we have a positive theta, which is very rare because usually when you buy a call, you'll have a negative theta. And what this means is the iron condor is paying you as time goes on. Whereas if you buy a call, so if I get rid of this, and let's say we buy a 426 SPY call, we're going to have negative theta as you can see here. So that means you're losing money as time goes on. So now you can really be on the other side and be taking money just for time. And that's why the strategy is really good when SPY, for example, as you can see here, kind of just hovers freely sideways. So that's going to be just a general introduction to what the spread is and the details. That's all you need to know about how to set it up. Just you can change up the strikes, obviously, if you would like to, but the general structure is exactly the same, always the same. And I'm going to go into a little bit more details now. So if we look here, so there's some intricacies that you'll learn as you trade the iron condor strategy more. So when I say the outer wing, so the further the outer wings, the faster you get paid for theta decay. But it also takes more collateral. So I'm going to explain what that means. So let's go back to Robinhood. So when I say the outer wings, let's look at here. So the outer wings are essentially referring to the two furthest out strike prices. So the 420 put and then the 427 call. So the further these are out within your inner ones, so if I change, so let's get rid of these. So now we have, let's see here, so we're at our call list. Okay, so we have this call right here. We sold a call. So now if we buy a call that's further out, so let's say we buy a call that's 430, and then we go to the put side, and we go sell a put that's really far out, so a 417 versus a 420. Or that's, sorry, I didn't mean to sell that, I meant to buy it. So we want to buy that. And as you can see, we're getting more credit, but it also costs way more collateral. So we have 400 collateral to pay. So when you want to submit this strat, this is going to cost you $226 versus the other strategy where it costs $38. So there's a little bit more, or a little bit less risk to reward because you have to pay more collateral. Thus, there's maximum risk. But because these outer wings are so far away from the current strike price, so the 417 is very far away from 425 in terms of the market. Same with 430, it's very far away. And it's also very far away from your inner strikes. So your 421 and your 426, those are far away. Those are your middle wings. Think of the 421 and 426 as your middle wings, and the 430 and the 417 as the outer wings that are, now you're putting them further and further away. So what that means is data is going to pay you faster because these are going to decay a lot faster because they're further away. So if you think about it logically, if you buy a 430 call, so let's go back to Tastyworks. So let's say you buy a 430 call, this is going to lose value a lot faster per dollar. Basically, you're going to lose a lot of value for this call because it's so far away. There's not much hope that SPY will go up to 430 where this will be profitable. So essentially, if you want to get paid faster for your Iron Condor, you want to choose further out strikes in the outer wings. So what that could look like, so if I write this here, so let's say, for example, we're going to edit this Iron Condor spread right here. So let's edit it. So we have the outer wing right here. This is the outer wing, and this is also this is the outer wing as well. So let's modify this to 430, and we're going to modify this to 417. We're keeping the inners the same. So if let me actually move this right here. So these are our outer wings, and these are our inner wings. So when we do this, when we make this further away, so if we go 410 even, and then 440, you're going to start getting paid a lot faster per day. So however, when you do increase the distance between the outer wings here and the inner wings, you're going to have to pay more collateral. So that's the trade-off that you get when you trade this strategy. This is where I'll summarize exactly what I just said. So if you're trading 0 date expiration, so say today is June 14th. If you're trading all these calls and they're expiring on June 14th, so very soon, basically in maybe a couple of hours, then you really want to lower these strike prices. So you want to make this a 427, and then you want to make this close as you can, so a 420. So when you do this, this works really well for 0 day expirations. So if these are all expiring within a couple hours or within the next day. So now let's say you're buying stuff that's expiring next week. So all these calls are expiring in a week. Then you can really start to expand these strikes out. So you can have a 440, and then you can probably have a 410 down here. And this is where it would work. Specifically, if you go back to having like a 427 here, and then a 420, so you're minimizing the distance between the outer wings and the inner wings, then you're going to not really see much profit until you get really close to the expiration date. So that's just to keep in mind. If you want to do longer dated Iron Condors, you must keep the outer wings further away from the inner wings just to make sure that you're getting profit for being right about the stock price. So that's just a little tip. I don't really see a lot of textbooks talking about that, but that's really important when you're trading Iron Condors. So I'll keep mentioning that in the Discord, especially when I make Iron Condor strategies and post signals about them. You'll see that if I'm ever doing an Iron Condor strategy with dates that are expiring really far out, I'm going to definitely keep a large distance between these strikes and then these strikes, so the inner and outer wings. But whenever I'm trading stuff that's expiring soon, you're going to see very minimal distance between the outer wings and the inner wings. So lastly, another kind of tip and thing I've gotten from trading this for a while is that the time to trade Iron Condors, the most profitable time, is when there's been a huge spike, so huge volatility. It could be a huge drop as well, just lots of volatility, but then you know that the stock price is going to consolidate after a while. So for example, let's go back to AMC. So I'm going to look at AMC for a bit. Let's see here. So a perfect time to trade AMC or Iron Condors would have been at the third wave up here. So just in general, for any third wave, when you have that huge push upwards and then a consolidation for the fourth wave, this is where you enter iron condor strategies, because after that explosive wave 3, implied volatility is going to be extremely high. So the options are pricing this in. So you're going to get paid a lot for opening an iron condor strategy, and then when the prices consolidate, that implied volatility is going to drop, and that's going to give your iron condor strategy, you're going to get money from that. So in general, from my opinion, the best time to open iron condors is after some explosive wave 3, because the wave 4 is usually choppy sideways price action, which is perfect for iron condors. So if you opened one right here, let me open the box. So if you opened an iron condor within this range, so for example, you did a 40 to 68 iron condor on AMC, that would have given you lots of money. And I did. I'm definitely looking to trade more iron condors, especially on meme stocks, because all the implied volatility for meme stocks are very high right now, and this would be a perfect time to cash in on some iron condors when I do see a good opportunity. So that's going to be it for this video. That was an introduction to iron condors and some of the details, as well as some specific examples of when you would use them, and I showed you how you can navigate them yourself on your own brokerage. So just to summarize, if you're using Robinhood, I've showed you exactly how you can do it on Robinhood. And if you're using something that has an options book, a trading book like Tastyworks has, Webull also has that, then you can do exactly what I just showed you as well. So hope that was useful. Let me know in the comments or in the Discord whether you have any questions on what I said, and I'll be happy to help you out. So thank you so much for watching, and I'll see you in the next video.